Hello, everyone. In this session, we're going to talk about the computing taxable income and the income tax liability. This is our chapter number 2 from the BPP textbook. So we're going to look at chapter number 2. One of the important chapter we have for this taxation paper, because from here we're expecting at least one question. So here we're going to look at how we calculate the tax liability based on different sort of income the individual have. For example, the person might have a employment income, the person might have a property income, the person might have a savings income or dividend income. So all this income together, how much tax you need to pay based on different level of earning. For example, the earning could be £50,000, the earning could be £100,000, earning could be £200,000. So we're going to look at in different situation and the tax rate and how we calculate all the taxation. So let's have a look. The first thing we're going to look at the chapter overview. So on the chapter overview, we're going to look at what we're going to cover. Just quickly explain a little bit the briefing before we go and practice some question. So let's have a look at the first thing. The first thing it says is scope of income tax. Now the scope of income tax is linked with the residence. So the scope of income tax is linked with the residence. Now, as we already know, it is possible the person live here in UK, but maybe is not resident because the residency test is not satisfied. It is also possible the person is resident here, but not domiciled here. So based on the different status, the person is a resident or not, the tax calculation will be very much implied on that person. So if the person is a resident, so there will be a tax implication. If the person is non-resident in UK, so there is no tax rule will be applicable on him. For example, if someone come for a holiday and he live or she live less than 16 days for the whole tax year. So he is automatically is not resident in UK, and for that reason, no tax rules will be applicable on him. So he will be not treated as a resident of UK, and if he is a non-resident, we will not be able to use any taxable liability or any taxation rules on him. So this sort of thing will justify who is resident and who is not resident. So we're going to look at some criteria. The main thing we're going to look at here, what is the condition for the automatic resident and which one is confirmed someone is not automatically resident. So we're going to look at all of this thing from here. Also, if someone is not automatically non-resident, but there are few ties the person have in the UK. For example, the person is from the UK, but he lives somewhere else. So this is his main home. Or for example, the person, wife or the children or the husband live here in UK, but he lives somewhere else. So there is a close tie. If there is a close tie, there are some condition we have, and it is possible the person can be resident or can be treated as a resident in the UK, even though he don't live here at all. So we're going to look at all of this thing under the residency test. The next one we're going to look at computing the taxable income. Here we're going to look at what type of income are taxable. So some income maybe is not taxable income. So if it is exempt income, we do not consider this one as a taxable income. So we only take if the income is taxable. That means HMRC said, if you have this sort of income, you have to pay tax on it. But there are few income, they said is it exempted. For example, ISA, individual saving income. So HMRC said if you have up to this amount for a tax year, you don't have to pay any tax because it is exempted. So we're going to look at only the taxable income because we like to calculate the tax. We want to see how much is the tax liability based on the different level of earnings. Then we have a type of income. So one individual can have a different type of income. The first one is called non-savings income. Non-savings income, as it says, non-savings, it is a very clear to understand, is not the interest. The saving income is basically the interest. So if I deposit some money and I receive some interest, that's the saving. But the non-saving income, the example of the non-saving income is the employment income, the property income. So normally the employment income and the property income you're going to see in the exam, and that will be treated as a non-saving income. On the other hand, the saving income is the income that I receive because of I have some savings. So normally we called it interest. So interest, if we receive, and that will be treated as income, but the criteria of calculating the tax will be different between the non-saving income and the saving income. The next income we have, that's the dividend income. Now, normally, this dividend income is only for the people who own some share. So if you own share for any company, you receive the dividend. Now, for example, if you are the shareholder of a company, and also if you are a director, so normally for this small company, the person who is the shareholder, he can be the director as well. So he receives some dividend. Now, for example, if someone receives a £10,000 dividend, how much tax will be on this 10,000 depends how much is the total income. Now, there are certain rules, but a few rules is very much clear. For example, the first 2,000 of the dividend is always tax-free, so it will be zero rated. First 2,000, regardless how much is the person income. So it could be 2,000 or 2 million income, but first 2,000 income from the dividend is always tax-free. So if he receives 10,000, so first 2,000 will be zero rated. After that, it depends what his level of income, which band he is following for the tax, and we're going to calculate the tax based on that. But first 2,000 is a very simple, is always zero rated. The next one is exempted income. Here we do not consider that. So there are some income HMRC said it is not taxable. So you don't have to pay tax on that. So that is called exempted income. For example, as I said, ISA individual saving income, there is a limit. Up to that limit, you don't pay any tax. So we're going to look at all of this. The next one we have here, personal allowance. So far, more or less, we are very much used to with this word, personal allowance, because all of us, we know up to a certain level of earning, we don't pay any tax. So for example, in 2023, the HMRC said if you earn 12,570, if you earn 12,570 a year, up to this amount, you don't have to pay any tax, so no tax. That means if your total income is 12,570 or less, you don't have to pay any tax because the whole income will be covered by this personal allowance. The reason government give the personal allowance to take some tax advantage by the people. So the government said, the HMRC said, the lower income people whose income is not that high, like 12,000 for a year is not that much income. So he need this money to survive or for his expenditure. So he should not charge any tax on that. For that reason, up to 12,570 in a year, there is no tax. So up to this amount, the tax will be free. So if someone earns £20,000 a year, so up to £20,000 a year, for example, someone earn, we will minus the 12,570 and the tax will be calculated on the rest of the balance. So 20,000 minus 12,570 on the remaining balance, we're going to calculate the tax. But up to 12,570, no tax. And then we have the next one. So the next, this personal allowances keep changing every year. So you need to make sure, like, the right amount of personal allowance is keep changing every year, April. Now, on the reference material, on the exam time, you're going to see all of this. Even though if you don't remember, you will get all the band, all the tax rate, all this thing you're going to see it on the exam. So you really don't have to depend on the reference material, because if you keep looking or if you keep reading during the exam time, you will be running out of time. For that reason, you should not depend on the reference material. This sort of information should be on your head so that you can do it faster in the exam. Then we have the next one, we have here the tapering the personal allowance. Now, this is very important. The reason it is important, up to a certain level, the personal allowance stays, and after that, it doesn't stay. What does that mean? That means the personal allowance is valid up to a certain level. That means personal allowance basically is for the people who have an income up to a certain level. Now, certain level means how much? Certain level means up to 100,000. So if the net income, if someone net income more than £100,000 a year, then for every £2 earning, he will lose £1 personal allowance. What does that mean? That means, for example, if someone earned 105,000, that means he is earning more than 100,000. So we're going to minus 100,000 from here. And the remaining 5,000, he's earning excess of 100,000. For every £2, he's going to lose £1 personal allowance. That means we're going to divide by 2. So 5,000 divided by 2 is 2,500. So he will lose 2,500 personal allowance. That means the total personal allowance we have 12,570. From there, we're going to minus 2,500. So his personal allowance will be now less than 12,570 because his earning is more than 100,000. So this one is very important. So as long as we added all the income together, and if we see the net income total more than 100,000, we have to stop and we have to check the personal allowance so that we can adjust the personal allowance and the right amount can be deducted from his total net income. All right. The next one we have here is computing the tax payable. How much is the tax payable? Now, the tax payable, the word is very important. This is word, that's the word to represent how much is my liability to HMRC. That means I have to calculate all the tax and we have to minus if there is any tax I already paid. That means is any tax is deducted at source. For example, if I have income from my employment, 50,000. So from my job, I have received 50,000 salary and I already paid £5,000 tax. So obviously I'm not gonna pay that tax again. For that reason, I will add my total tax. I'll calculate all the tax together and I'm going to minus this 5,000, the PAYE already paid. So this is called tax deducted at source. So if we already paid any tax at source, and this calculation will be reduce my tax liability. So that amount I'm going to reduce from the total tax liability, and the remaining balance that I have to pay to HMRC, we call the tax payable. So you need to be very careful on every single word. So tax liability, tax payable is not the same thing. All right, the tax rate is it depends because the non-savings, the savings, the dividend, the rate is different. For example, for the basic rate, the tax will be 20% up to the basic band. So that is 37,700. Up to this amount, the tax rate will be 20%. More than that, up to 150,000 is 40%. that is called higher rate tax. And after that, from 150,000 or above, if someone have a earning more than 150,000, we call them additional rate taxpayer. So any earning above that, excess on this amount will calculate 45% tax. We're going to look at everything. For the non-saving, we have some allowance. We're going to look at that. And also for the dividend. So we have a rate for the basic rate taxpayer. We have a one rate for the higher rate taxpayer, and we have another rate for the additional rate taxpayer. So you have to remember three rate for the taxpayer: basic, and we have a higher, and we have additional three. All right, then we have a computation of non-saving. Okay, computation of non-saving dividend and transferring personal allowance. Now this one is very simple. That is, if you are married and if your wife or if your husband is not earning enough to cover the personal allowance, it will be good for you to transfer some personal allowance to the husband or from the husband to wife. For example, let's say your husband, let's say your wife earned £10,000 and the personal allowance is 12,570. So whatever she is earning less than 12,570. So actually, you cannot claim back the personal allowance from HMRC. So you are losing at least like 2,570, because even if you earn more 2,570, you don't pay any tax. So for that reason, you can say like, okay, as my earning is less than 12,570, only 10,000. So from my personal allowance, 12,570, I want to transfer some personal allowance. Normally that is 10%. I want to transfer to my husband or wife. So what will happen? The another person, husband, have a personal allowance 12,570, and this 10% from the wife, it will be added here. Let's say 1,260, so it will be added. So his personal allowance will be now increased. So from 12,570, it will be increased to 13,000 something, how much it is. So it will be increased. That means he will not pay the tax up to 13,000 on that amount. So what we understand, if the earning for one person between husband and wife, if one person income is low, then another person can transfer the 10% to the husband or between husband and wife, so that one person will pay little bit tax. But if both person earning more than 12,570, it is not helpful, because you transfer to them, or like husband or husband transfer to wife, someone will pay more tax. So it is only suitable if one person earning is low. And in real life, if you are husband and wife, you can claim your marriage allowance last 4 years. So that means like, for example, if you never claim your marriage allowance, and if you married, for example, 2015 or 5 years before, you can fill a form online, or you can call HMRC and you can claim the marriage allowance. So if you already paid some tax, you will get last 4 years tax back. If your wife or husband have a lower income, you can tell like, we didn't claim it, and you can claim 4 years before, so from 4 years back, and roughly £800 to £1,000 you can claim back from HMRC. It depends on the earning. So many of us, like so many people, they never claim it because they don't know it, but you can get a check from HMRC within few weeks after you apply. It's a very simple and straightforward process. Anyway, so the next one we're going to look at is called gift aid. So the gift is basically when you make a donation or like a charity, then there is some tax advantage you will get. For example, your basic band will be extended. Let's say, for example, up to 37,700. For example, we don't pay, we pay the tax up to 37,700. We pay the tax 20%. Now, let's say, for example, if we have a gift aid gift aid or like a charity or like a donation. For example, you pay someone, let's say £4,000 on the charity. And this £4,000 you paid as a net to the charity, but the HMRC will give you the opportunity to gross it up. That means you can divide by 0.80 and you'll gross it up. For example, if it is 5,000, this 5,000 will add with the basic band. So normally up to 37,700 you pay tax 20%, but now it will be 37,700 plus 5,000. So your basic band will be extended. That means you are paying less tax. Before, if any income more than 37,700, you pay 20% tax. Now, because of the gift aid or the charitable donation, what will happen? Your basic band will be extended. That means you will take a tax advantage, so you pay less tax on that amount. And you always add the gross amount, even though you paid net, but you gross it up first, then you add. So you have to remember that. All right, so I think qualifying interest, so it's not very difficult. I think that's all we're going to cover from this chapter. So let's have a look. Yeah, that's all. So let's look at the residency test first, even though very hardly any question come in the exam, but you need to know that, how does it work. So let's have a look. So here we can see we have a table, and this table will help us to understand. But before that, we will read three things. The first thing we're going to read, automatic overseas test. Automatic overseas test represent you are not automatically resident in the UK. So you are not automatically resident. So let's have a look. The automatic overseas test must be considered first. That means before I consider automatic UK test, or before I consider sufficient tie test, I need to consider the automatic overseas test first. So I'm going to consider this one first before I consider the automatic UK test or the tie test. So that's my first test I'm going to look at. If I'm not satisfied, then I'll go to automatic UK test. And if I'm not satisfied after that, then I'm going to check the sufficient tie test. An individual will automatically not be UK resident for the whole tax year if they spend less than 16 days in the UK during the tax year. So it's very important. Remember these days. Less than 16 days, automatically non-resident. They spend less than 46 days in UK. They spend less than 46 days in the UK. So this one, we have some more information. Let's read that. During a tax year and were not resident during the previous 3 tax years. So there's 2 conditions. So you did not live 46 days in 1 tax year. Also, the last 3 tax year, on the previous 3 tax year, you were not resident in the UK. They work full-time overseas throughout the tax year, spend less than 91 days in the UK during the tax year. So they work full-time somewhere outside of the UK and spent less than 91 days in the UK during the tax year. So if one of the condition is satisfied for the whole tax year, they will be treated, they're not resident in the UK. So if you see someone is living less than 16 days, you don't have to check anything else. You say like, oh, he's living less than 16 days, he's not the resident of UK. And if someone live more than 16 days, let's say 30 days, you have to say like, okay, you spent 30 days, but last 3 years, are you resident in the UK? If the answer is no, then you are not resident in the UK because it is less than 46 days. Then if someone live more than 46 days, let's say someone live 50 days in UK, then you have to see like, oh, do you work overseas full time? Yes, then you are not resident in the UK because you live less than 91 days. So this is the first test we do before we decide, are you resident in the UK or not? The next one we have here, that is called automatic UK test. If none of the automatic overseas tests are met, then automatic UK tests are considered. So if the first one we think we cannot satisfy this condition, then we move to the next one, that is automatic UK test. An individual will automatically be UK resident. It will be automatically treated as a UK resident. They are in the UK for 130 days or more during the tax year. So if you live in the UK more than 183 days, you will be automatically treated as a resident of UK. Their only home in the UK. So if they're only home in the UK, they carry out full-time work in the UK during the tax year. So if this has happened to anyone, we'll treat them as a automatic resident. So if you live more than 183 days, you are automatic residents. You can see this one is or. It's not and. So if one of the condition is satisfied, that means you are automatically resident on the UK. Then the next one is sufficient tie test. Here it says, if an individual residence cannot be determined by any of the automatic tests, their status will be determined by the number of tie they have with UK and how many days they are present in the UK in the tax year. There are 5 ties. So let's have a look. Having close family in the UK, that's the first tie. The first one, spouse, civil partner, or minor child. So if this has happened, your wife, your child live here, you don't live here, so this is the first tie. That means you have a close connection with the UK. Having accommodation in the UK in which the individual spend at least one night during the year. So you have a accommodation in the UK and at least you spend it one night on that house or on that accommodation. Doing substantive work in the UK, so you have some major work to do. That means like at least 40 days you work in the UK and at least 3 hours a day. So 40 days, at least 3 hours a day. That's the tie number 3. So move to the next page. The next one we have here, tie number 4, being in the UK for more than 90 days during either 2 of the previous tax years. So in previous 2 tax years, he lived in UK at least 90 days. So that's tie number 4. Spending more time in the UK than any other country in the tax year. So for example, out of 365 days, you live more than half of the days in UK and less time you spend somewhere else. Only relevant if individual who UK resident in any of the previous 3 tax years. This is tie number 5. The following table showing the number of tie by reference to the number of days in the UK will be provided in the tax rate and allowance in the exam. So you'll get this one in the exam. You can see this one anyway. Okay, so let's have a look. Days in the UK, very simple. Less than 16 days, we don't have to think anything. If someone live less than 16 days, it's like a visitor. We will not treat them as a UK resident. So less than 16 days, automatically not resident, automatically not resident. 16 to 45 days, then we have to stop. Resident, if 4 UK tie. So you see all the tie we have checked before. So if 4 ties is satisfied, like they have a children, they have a home, they do some substitute work, and they live 16 to 45 days, then you can say resident in the UK. But if not previously resident, then not automatically resident. So you will say you are not resident. So previously resident and not previously resident, very careful with that. 46 to 90 days. If someone live in the UK 46 to 90 days, then also in the previously he was resident in the UK, then if 3 ties is satisfied, 3 or more ties from the 5 ties, then you say you are the resident of UK. If he never been resident in the UK before, then he will be treated as a resident if 4 ties satisfy. So he have a home, he have a children, he have a wife, he work here, so 4 ties need to be satisfied if he never be resident before. But if he was resident before in the UK, then only 3 ties. Then 91 to 120 days, if 2 ties satisfied and he was previously resident in the UK, then he will be resident. If he never been resident before, then 3 ties need to satisfy. If someone live 121 to 182 days, and if there is only 1 tie, for example, he have a home in the UK, or he have a child, he have a wife, or 1 tie satisfy, he will be treated as a resident if he has a previous residency. If not, then 2 tie need to satisfy if he never be resident before here. More than 183 days, just automatic resident. We don't have to look at any tie, nothing. Previous resident doesn't matter. Never be resident doesn't matter. Previously resident, don't have to think anything. More than 183 days, automatically resident. Less than 16 days, not automatically resident. So these 2 are very clear. More than 83 days, we don't have to check anything. He's automatically resident. Less than 16 days, he's not resident. So very simple. All right, so let's have a look. One of the activity we have here. Activity 1, say UK resident or not UK resident. So let's look at this question. So it says, in one tax year, Sally is spent 15 days in the UK. Sally is spent 15 days in the UK. In one tax year, Sally spent 15 days. Now we already know if it is less than 16 days, we don't have to worry anything. He's not automatically resident because less than 16 days, we don't have to look at any tie. We don't have to look at any more information. We say he's not automatically resident in the UK. So state with the reason whether Sally would be UK resident or not. We'll say not automatically resident because she lived less than 16 days a tax year. We don't have to look at anything else. Less than 16 days, very simple. More than 183 days, very simple. Less than 16 days, not UK resident. More than 183 days, automatically UK resident. So that's quite simple for us. Let's move to the next one. The next one is says UK resident, activity 2. Jimmy has lived in Tokyo where he owned a house all of his life. He came to UK on 1st May 2022, having sold his house in Tokyo. That means as soon as he sold his house in Tokyo, he don't have any house Tokyo anymore. The month before, he decided to buy a flat in London, which he used as his only home. That means he have 1 tie here. He don't have any home anymore in the Tokyo because he sold it. And he have now only home in the UK. Jimmy lived in the London property until 30 September and then went on a backpacking holiday for a year. So he is going for a holiday. Now, the requirement state with reason whether Jimmy would be UK resident in the tax year 2022 and 3. So we have to know how many days he lived during the tax year and if there are any ties satisfied. So let's look at this information once again. So as we remember, the first thing we'll do, we'll check the automatic overseas test. So let's have a look. If you remember the automatic overseas test, so automatic overseas test was saying us if someone live more than spend less than 46 days. Now less than 46 days because he's living from May to September. May to September. Now, obviously, like our tax year is started from April. So we can see May to September is May, June, July, August, September, 5 months. 5 months. And if we multiply with 30, so 150 days he lived. He lived in the UK. So that means he lived more than 46 days. It's not less. So more than 46 days. So automatically he does not satisfy the automatic overseas stay. So we will not consider that because he lived more than 46 days. And then the next one is say they work full-time overseas. So the next condition, if you live, if you spend less than 91 days in the UK, and also like if you work full-time overseas. Now he's not working overseas full-time, isn't it? Because he just going for a holiday. If we read this one once again, is a he going for a holiday. So that means like he is not working Tokyo anymore. So he permanently moved to London. He buy flat in London. He said he will live here. So he will not go back Tokyo anymore, and he don't work full time. So this overseas test does not satisfy him to say he's not automatically resident in the UK. So now we'll look for the automatic UK test, the next one. And next one, it says like if someone live 183 days, he didn't live 183 days for this tax year, is less than that, but they're only home in the UK. So this one is satisfied. Now he have the only home in the UK. So if you have only home in the UK, that means you are satisfying the automatic UK test. And if it is that, then he will be treated as a UK resident. So if none of the automatic overseas test is satisfied, then you move to the automatic UK test. And according to the automatic UK test, he is the resident of UK because he have only one home in the UK now. So we can say as none of the overseas tests satisfy and only he have the UK home now, so he will be treated as a UK resident. So you say yes, he is a UK resident. Because only home in UK and none of the overseas test satisfy. That's it. All right, let's have a look at the next one. The next one, we have the sufficient tie test. Let's read this one. Say Andy was UK resident in the tax year 21-22, so the previous tax year, because we are doing now 22-23, so he was the resident. So he was the resident previous tax year, but was only present in the UK for 80 days in that tax year. So 2021 and 22, he was present for only 80 days. He does not satisfy either the automatic overseas test or the automatic UK test in the tax year 22 and 23. That means we check the overseas test, it's not satisfying anything. Then we check the automatic UK test, he is not automatically UK resident. So now we'll need to look for the tie. Is there any tie he have? The question already gave us the information. He was previously resident in the UK. In the tax year 2022 and 23, Andy spent 48 days working 5 hours a day. So we know if someone is working 3 hours a day, and if someone does substantial work, that is 46 days. Just quickly have a look, the table. Yeah, so substantial work, and that is 40 days, not 46, 40 days, 3 hours at least. So he was working for that. So he was working 40 days, more than 40 days, 48 days, and by 5 hours, that means more than 3 hours. So one tie is satisfied here in the UK where he was present at midnight. And his wife live in the UK. Okay, so wife, there is another tie. And also the joint home. So he have had accommodation, 3 ties. And Andy leaves the home when he is in the UK. And he spent at least the rest of the tax year in Spain. All right. So you can see a few information. The first information, he was previously resident. So looking for the first one, previously resident, and he spent 48 days. So let's have a look at the table once again. So the table said if someone live 48 days, that means between 46 and 9. So 46 and 19 because he was living 48 days. So if he live 48 days, he comes under the 46 to 90 days. And he was previously resident in the UK, so he need to satisfy at least 3 ties. So what is the 3 ties? The first tie, the wife. The next tie, the accommodation. And the third tie, the substantial work. That is 40 days, 3 hours a day, and he did that. So 3 ties is satisfied, and we can say he is automatically resident. He's a resident in the UK because of the tie. So we have all the information, and we say yes, he is the resident of the UK because 3 ties is satisfied. He was previously resident in the UK, and he spent 48 days. And the first tie is working 5 hours, and the wife and the accommodation. So it looked like he was the resident in the UK. All right, so this is it for the sufficient tie. Hopefully you understand that, but this question is not very much unique in the exam. Sometimes they can have a MCQ type question, but it's not very like big question you're going to see in the exam for the residency test. All right, let's have a look our main area, the tax computation. All right, so we have a template here. Just quickly have a look at this template. In the exam, you have to make this template, and on the scrap paper, you need to do the workings by following this template. So first, we do the non-saving income, then we do the savings income, and we have a dividend income. So trading income from the business, if there is any trading income, we take that. If there is a loss, we take away. So trading income minus the loss. Then we take the employment income, property income. So all this my non-savings income. After that, we can take the dividend, or we can take dividend later on. We can take the building society, it's the same thing. So building society or bank interest, that's my saving income, or other interest. Remember that mainly the interest is the savings income. And after that, we added these two together. That's my savings, and that's my dividend. Then we have a total income. So this is the total income we have from the non-saving, from the saving, and from the dividend. And from there, we minus the qualifying interest and the less loss relief. It's not very common in the exam, but if you have any qualifying interest or if you have any loss relief, you minus this two from the non-saving, and that gives you net income. You have to stop here because this is a very important point. We have net income, and we added the net income for the non-saving, for the saving, and for the dividend. We added these 3 to find it out, the total net income. The reason we have to find the total net income, because based on that, we have to see, is there an implication on the personal allowance? Because if my net income is more than 100,000, remember, the personal allowance will be reduced. For every £2, £1 will be reduced. For that reason, we have to stop on the net income. There is another thing is called ANI, adjusted net income, that will have impact on the personal allowance because of the gift aid donation or for the charity. I'm going to show it later on, but you have to remember every single time. Then we minus the personal allowance from the net income, and that gives us the taxable income. And in this taxable income, we're going to calculate the tax based on the different level of rate. So this is the first template that has to be on our head. Let's move on. The next one we have here, we know the savings, we know this thing, the exam income. You can see here it says It says income from the certain investment exempted from the income tax. They are therefore useful for tax planning to minimize the tax investment. Exempt income could be income from the National Savings Certificate, statutory redundancy money. Redundancy means like if you leave the job, not by your choice, if the company said like we don't have any work for you, and if they want you to go for redundancy, they may give you some lump sum payment. Normally they give you the next 6 months salary. So if they give you lump sum amount, it is exempted from the tax purpose. Then you have a winning. So if you win a prize, lottery or bond, something, a scholarship, interest on damage personal injuries. So if you have a damage for personal injuries, local authority grant, and income from the investment. So this is ISA, individual savings account. These things are exempted income. But for the ISA, there is a limit. The limit is 20,000 per tax year. So you have to remember the exempt. So other thing is not very difficult. Non-saving is very simple. Savings is very simple. For example, the bank interest, all the interest basically. As soon as you see the interest, is a saving income. And the dividend income is a dividend received from the share. We already discussed that. If I am a shareholder for any company, I receive the dividend from that company. All right, so let's move on to the question. More we practice, we'll understand more. So we need to practice more. So let's have a look. The personal allowance, how does it have impact? Now, as I said, if the income is more than 100,000, there is impact on the personal allowance. They said here, an individual adjusted net income, ANI, exceed 100,000, the personal allowance is reduced by £1 for every £2. Okay, let's have a look. That means if the total ANI, adjusted net income, if it is more than 125,140, then there is no personal allowance. So if you see the total adjusted net income is more than 125,140, so you really don't have to worry about the personal allowance. Ignore the personal allowance because this person is not entitled for the personal allowance. So if the income is more than 125,140, net adjusted income, so ANI, adjusted net income, more than 125,140, ignore the personal allowance. So you need to know this thing. As soon as you see the income is 130,000, ignore the personal allowance. All right, so what is ANI, adjusted net income? Adjusted net income is the net income less gross amount of personal pension contribution or gift aid donation. I'm going to show it what is it, but it's the gross amount. As I said before, in the exam, the question will give you the net amount. We have to gross it up. All right, so let's have a look. One illustration. Let's have a look for an example we have here. So it says, in 2022 and 23, Claire received employment income. So that's the non-savings income, 95,000. So non-saving income. Bank interest, 8,000. That means it's a saving income. And dividend, 7,500. It's a dividend. Dividend income means it's a dividend. Calculate Claire taxable income for 2022 and 3. So we are calculating the taxable income here. So we have a non-savings, so 95,000 employment income, no problem for that. Bank interest 8,000, savings income, no problem for that. Dividend 7,500, no problem for that. So this question is very simple. Net income is 95 plus 8 plus 7,500. Total income, total net income 110,500. Now, as I said, if the income is more than 100,000, if the net adjustment income or adjusted net income more than 100,000, we have to stop. Now here it is more than 100,000 because it is 110,500. So you have to stop because my personal allowance need to be adjusted. How I do that? So I will say how much is the net income, 110,500. So we take 110,500 and we minus the limit. How much is the limit? Maximum 100,000 limit for the personal allowance. So we minus that. So how much is excess? So excess is 10,500. And for every £2, £1 will be reduced. So we divide by 2. And that will give us my reduction. So if we divide by 2, 10,500 divided by 2, that gives me 5250. And from the total personal allowance, I'm going to minus 5250, and my remaining personal allowance will be 7320. This is the one I'm going to minus from the non-savings income. So you can see this is the one I'm going to minus from the non-savings income to find my taxable income. Now you might thinking like, why we always minus the personal allowance from the non-savings income? Why we don't minus from the savings income or from the dividend? The reason is only the non-savings income, we don't have any allowance. That means there is no allowance I'll get for the non-saving income. Whatever the non-saving income, I have to pay tax straight away. But when I have a savings income, if I am a basic rate taxpayer, that means up to first 1,000, I'll pay tax on zero rated. If I am the higher rate taxpayer, the first 500, I'll pay the tax on zero rated. If I'm additional rate, then there is no allowance. For the dividend, first 2,000 is free for me. So that means on all the other income, savings and the dividend, I have some allowance. So I don't want to use my personal allowance there where I'll get some other allowance. For that reason, all the personal allowance I used from the non-saving income first. But there is no restriction. If you want to use your personal allowance from any other income, you can do that, but you will end up with more tax liability. That's the reason. All right, so hope we understand this one, this example. Let's have a look at the next one. So we have one example. Let's try to do this example. It says personal allowance. Jesse has net income 105,000. Jesse has net income 105,000. Require what is the personal allowance for the tax year 22 and 23. So let's do that. So net income. So they already added everything and they give us the net income. So you don't have to find what is the non-saving, what is saving. So they already calculate everything for us. Net income. So all you have to do is to say, okay, as the income is more than 100,000, we need to make some adjustment for the personal allowance. So we need to say 105,000 minus the limit is 100,000. So minus the limit. So the excess is 5,000, and for every £2, £1 will be reduced. So divide by 2. So that means 2,500 will be reduced from personal allowance. So my normally personal allowance is 12,570, and I'm going to minus 2,500 from there. So let's do that. And if I minus that, so I will have how much left? So 10,070. So that will be my personal allowance left. So we have, the question is, what is the personal allowance? So they didn't ask for any tax liability. I think personal allowance, so that will be 10,070. That's it. Very simple. We need to minus the limit, divide by 2, reduce from the total personal allowance. That will be my personal allowance. This one I'm going to minus from the income to find the tax. Very simple, the first one. Let's move on to the next one. The next one we have here, tax liability. As I discussed this one before, income tax liability means the amount of tax charged on the individual taxable income. So how much is the liability? This is called tax liability. So based on my taxable income, how much liability created, it's called tax liability. But remember that income tax liability, if 10,000, doesn't mean I have to pay 10,000 to HMRC, because maybe I have already paid some tax at source. So maybe some tax is deducted at source. I'm going to take away that tax, that is PAYE. Income tax payable, the balance of the income tax liability still need to be settled in cash. That means still I need to pay for that. All right, so let's move on to the next one. We have some tax rate. Let's have a look at that. I need to remember this tax rate. So first we have a basic rate band. Basic rate band for the non-saving is 20%, for the saving is 20%, and for the dividend is 8.7%. It will be given in the exam, but it's better if you remember it. Higher rate band if your income is more than 37,700. If the net income is taxable income is more than 37,700, then the non-savings tax rate will be 40%, savings 40%, and the dividend 33.5%. If someone is additional rate taxpayer, that means if the income is more than 150,000, the non-saving tax rate is 45%, savings 45%, and the dividend 39.35%. Now, there is one thing that you have to remember, that is the 0% saving starting rate apply to saving income only if the first 5,000 taxable income. If non-saving income after the personal allowance is greater than 5,000, then the starting rate does not apply. It's very, very complicated. You need to understand that, what they are trying to say. They're trying to say here, let's say your non-saving income is 30,000. That means from the 37,700, the basic band, if I minus the 30,000, still we have 7,700. And in this case, from here, you can use 5,000 for the saving income as a nil rate band. For example, if your saving income is 10,000, so for the first 5,000, you'll pay 0 rated. So this is the one they're trying to say. But for example, if your non-saving income is 40,000, that means it is more than 37,700. In this case, if your savings income is 10, then you will not get any 0 rated because all the basic band is already covered by the non-saving. Now, if your non-saving, for example, is 35,000, that means you have only 2,700 left for the basic band. So you'll get only 2,700 for the saving income for the nil rate. So nil rate is only applicable if there is any basic band remaining from the 37,700 after take away the non-saving. If you don't have anything, you don't get this 0 rate. Now, if you are a basic rate taxpayer, first 1,000 for the savings income will be 0 rated anyway. If you are a high rate taxpayer, for the first 500, you have a 0 rated. For the dividend 2,000, you already know. But this one is only applicable if you have non-saving income less than 37,700, and if you have a balance of 5,000. If it is less than that, you can only have this balance. But you're going to see some question anyway. Let's have a look. All right, so if you look at this example, it says non-saving income only. All rates of the tax on non-saving income, okay. In 2022 and 23, Milo has employment income, that means non-saving income, and property income. So both are non-saving, employment and the property. So 145 plus 10,800. Calculate the Milo's tax liability. Okay, it's quite simple. They didn't give any additional information. So employment income 145 and property income 10,800. And my total income is 155. Remember, if the income is more than 125, 140, then we have to ignore the personal allowance. We really don't have to think about it because we only think between 100,000 to 125, 140. So between these, there is a possibility the personal allowance will be reduced. But if it is more than 125, 140, just forget the personal allowance, ignore it. So that's the total net income. Now, on the income tax, we see the first basic band is 37,700. This one you have to remember. You can memorize it because every time you do the tax calculation, you have to always use this figure 37,700 times 20% because you'll see it everywhere. For that reason, if you remember, if you memorize it, like 20% of the 37,700 is 7,540, you can always use it in the exam without using the calculator, because the basic band remains same. It will never change. So basic band 37,700, 20% of that is 7,540. So my total income is 155. So I am a additional rate taxpayer. So up to 37,700, I'm a basic rate taxpayer. From 37,700 to 150,000, I'm a higher rate taxpayer. If I earn more than 150,000 a year, I'm an additional rate taxpayer. So here my earnings is 155,800. That means I'm a additional rate taxpayer. So first 37,700, I'm paying tax 20%. That is here 7,540. Then the difference between 150 and 37,700. So the difference between the higher band and the basic band, I will pay 40%. So the difference between 150 minus 37,700 is always fixed. Remember that, because HMRC already said 37,700, then 150, then more than 150. So I pay 40% tax on that. This is 44,920. And more than 150, so 150 minus 155,800, that's my income. So excess of more than 150, that is 5,800, my tax rate will be 45%, that is 2,610. If I added all of this, I need to pay tax liability 5,570. Now the question didn't tell me, did I pay any income for the employment income? If the question said like, oh, we already paid the PAYE 10,000, for example, then this 10,000 we need to minus from here, because this one I already paid. But they didn't say anything about this. They said tax liability, not tax payable. Remember that tax liability and tax payable is not the same thing. They just asked for the tax liability, not the payable. All right, let's move to the next one. We have a next example, and this example they're also asking for the tax liability. All right, savings income, this time savings income and the non-saving. So Alice has a trading income that is non-saving 15,170, and the bank interest 8,000, that is savings. So you make a template, non-saving, saving. So trading income 15,170, non-savings, bank interest 8,000, saving. So you have a net income 15,170 and 8,000. Then we have a total income 23,170. That is very much less than 100,000. So we have no problem with the personal allowance. The full personal allowance is available because our income is less than 100,000, a lot, only 23. So I will use the full personal allowance, and I'm going to use it against the non-saving. I will explain. We always use the personal allowance against the non-saving income first, because there is no allowance for that. So if I minus that, my non-saving income is 2,600 after minus the personal allowance. My savings income is 8. So my taxable income is 10,600. Now I need to pay the tax, calculate the tax on 10,600. But I'm not gonna do like 10,600, 20%, no, because we have a non-saving and savings, we have a different rate for that. So the non-saving, I have only 2,600, so 20% of that, that is 520. Now, as we discussed before something, if we have any balance for the basic rate, then obviously we can use it. If we have any remaining balance, we can use it for the starting rate band. Now, if you have a look here, savings income, my savings income is 8,000. Now, the starting rate, we can use the 5,000. This is the maximum balance, 5,000. But if I use already something for the non-saving, it will be reduced from there. So from the 5,000, I have to minus any non-saving. So I have a non-saving income 2,600. So I minus the 2,600. So from the 5,000, I have only 2,400 left that I can use the zero rated. Remember that 5,000 is the maximum for the starting savings nil rate band, but it will be reduced by any non-saving income if we have after the personal allowance. So after the personal allowance, we have 2,600. From the 5,000, it will be minus 2,600. So first 2,400, I'll get 0%. So 2,400, I have 0%. I don't have to pay any tax because this cover with the starting nil rate band. The next one is 1,000 zero rated. Why? Because I'm a basic rate taxpayer. How do I know I'm a basic rate taxpayer? Because my income, my total income is only 10,000. Net income is only 23,170. That means if my net income is less than 37,700, I'm a basic rate taxpayer. I'm a basic rate taxpayer. And if I'm a basic rate taxpayer, I have an allowance for the savings income 1,000. First 1,000, I don't pay any tax, zero rated. If I'm a basic rate, if I'm a higher rate taxpayer, that is up to 150,000, the first 500, I don't pay any tax. So here I'm a basic rate taxpayer, so I have a 1,000 zero rated, I don't pay any tax. So if we added now 2,600 plus 2,400 and 1,000. So from my 10,600, how much is remaining? So from 10,600, the 2,600, I already paid the tax, that is 20%, so 2,600. The next 2,400, I'm not going to pay any tax, zero rated, so minus that. And 1,000, I'm not going to pay any tax because I'm a basic rate taxpayer. So 1,000, I have a nil rated. And if we minus all of this, so we can see my savings income actually 8,000, not 10,600. So from the 8,000, if I minus 2,600, minus 2,400 and minus 1,000, I have only 4,600 left. And in this 4,600, I'm going to pay 20% tax because I'm a basic rate taxpayer. So on this 4,600, I'm going to pay 20%. That's 920. That's my tax rate. So remember that the non-savings is very clear. Whatever is a non-saving, 20%, because it is less than 37,700. But savings, we have to make a split. You have to be careful with the starting rate because this is 5,000, and you have to always look at the savings. We need to minus it. If the savings here, for example, is 6,000, remember that there is no 5,000 left, so it will be zero. So I'm not going to get it. It will be zero. Very careful with that. All right, let's move to the next one. The next one, we have another example. So let's have a look what they're saying here. This illustration 4, savings nil rate, basic rate, higher rate with the savings income. So Joe has employment income, that is non-saving, bank interest, that is saving. So we have the total income, total net income, 52,270. This is a less than 100,000. So we're happy with the personal allowance. Minus the personal allowance, we have a taxable income, and the savings total is this, 39,700. Now you can see here my non-saving income is 34,150. That means it's more than 5,000. So I'm not going to get the starting band for the savings income, but I am higher rate taxpayer, 39,700, because more than 37, more than 37 and 700. I'm looking at the net income actually. So 52,270, I'm more than 37,700. So I'm a higher rate taxpayer. That means the 500 only I'll get the allowance for the savings. I'm not going to pay the tax, only 500, not 1,000, because I'm a higher rate taxpayer this time. So let's have a look. Non-saving 34,150, 20% straight away, no problem for that. And the next one, we have a savings income. On the savings income, remember that I have no starting rate because I have covered everything. Starting rate is only if I have some remaining from the non-saving. For example, here if it is 3,000, then I have 2,000 with the starting for the saving, zero rated. But here I have more than 5,000, ignore that. I'm a higher rate taxpayer. First 500, I don't pay any tax, so nil rate, zero. Then the rest, how much we have left from the basic band. Now the basic band is 37,700. From here, we already used 34,150 for the non-saving. And also we minus the 500 for the nil rate. So how much I have left? I have 3,050 from the basic band. So here I'm going to use my 20%, because if it is more than 37,700, I have to pay higher rate tax, that is 40%. So 3050, that gives me 20%, 610. And anything more than that, so my total is 39,700. So if I have from 550, if I have 500 minus, and also I minus 3050, that means still I have some saving income 2,000, and I have to pay 40%, because in total I already cover 37,700. So if it is more than 37,700, I have to pay 40% tax. That's the reason. So I have to pay 40% on that. It is 800. So my total tax liability is 8240. All right, that's not difficult. Let's move to the next one. I think this is not also difficult. We can look at one question for the dividend. Let's look at the dividend. All right, here it says 2022 and 23, M has employment income 60,720, building society interest 16, that is savings. So this is non-saving, saving, and the dividend 12,000. So we make the template, non-saving 60,720, and we have a savings, and we put the dividend on the dividend column, that is 12,000. And my net income, if we added these three total, that is 74,320. This is less than 100,000. No problem with the personal allowance. So we can get the full personal allowance, 12,570. So we have a taxable income, 48,150 plus 16 plus 12,000, 61,750. So we need to calculate the tax on this amount, 61,750. First, calculate the non-saving. So non-saving is 48,150. That means it's more than 37,700. So you need to find the difference. So 48,150. And we know up to 37,700, we have a 20%. So you need to find the difference, how much it is. So then the rest will be 40%. So first 37,700 is 20%, is always fixed. And the difference between 48,150 minus 37,700, that gives me 10,450. Here I have to pay 40% tax. And 40% gave me 4,180. With the savings, 61 represent I'm a higher rate taxpayer. This is between 37,700 to 150. So I'm a higher rate taxpayer. That means it will be 500 for me, the allowance of zero rated. So I said savings 500 zero rated, and my savings income is total 1,600. So 500 will be zero. Another 1,100 I have to pay 40%, because 1,600 minus 500. So on 1,100 I have to pay 40%. Why? Because I'm a higher rate taxpayer. All my basic band is covered by the non-saving income. So that gives me 440. And the dividend. Dividend is quite simple. The first 2,000 is always free. So first 2,000 always zero rated. And rest of the 10,000 will be the higher rate. The higher rate is 33.75. So multiply by 33.75, and that gives me 3,375. So you can see the first 2,000 is free, and rest of the 10,000 is 33.75%. This is the amount. So my tax liability is 15,535. Quite simple. All right, let's move on to the next one. Let's have a look. What is the next one we have? The next one we have here, one question. Activity 5. Let's try to do this one. So it says income tax calculation. Holly receive a salary of 45,420. That means it's a non-saving income. Non-saving income. PY deducted 6,570. That means this is the tax he already paid, or she already paid. So it's a tax at source. So this is the total tax she already paid from the employment. So we need to minus this one from the total tax liability. So first we calculate all the total tax liability, then we minus the 6,570, so that we can say this tax is payable to HMRC. 8,000 of a bank deposit interest in the tax year. So this is a savings income. Then we have a Marilla has a property income, non-saving. Interest, savings income. And Fabian has interest income, savings income. Okay. Let's look at the Holly first. what is the Holly income tax payable? How much tax she need to pay? So let's do that. So we have a non-saving 45,420, and the savings we have 8,000. So let's do the calculation for the tax. So if I added this to 45 plus 400, 8,000, so 45, 420 plus 8,000. So that will tell us how much is the total income. So we can see here, that's my employment, and this is for the bank interest. Okay. So if I added this to, so it will definitely less than 100,000. 45 plus 8 is 53,420. So 53,420. So that is less than 100,000. That means I have my full personal allowance. The reason I always add this to see is my personal allowance will be reduced or not. So I have no problem with that. So I can get the full personal allowance and minus the personal allowance from where? From my non-savings. So 12,570. And that will tell us how much is my remaining balance taxable income for the non-saving, 32,850, and here I have 8,000. So that's my taxable income. If I added this to 32 plus 850, that gives me 40,850. So this is my taxable income. The tax need to be calculated on this amount. So let's do that. So the first thing we need to do, we need to find how much is the non-saving. So non-saving is 32,850. So we need to pay 20% tax on that because we are a basic rate taxpayer. Up to 37,700 is the basic rate. So 32,850. So 32,850 times 20%, that gives me 6,570. 6,570. And for the saving, as I'm a basic rate taxpayer, so first to 1,000, I'm not going to pay any tax. So, but before we do that, we need to always careful, like, sorry, I'm not basic, I'm a more than 37,700 because my total income is 53. So it's more than 37,700. So I'm a higher rate taxpayer. If I'm a higher rate taxpayer, I'll get only 500 allowance. So first 500, I'll pay zero rated. And rest of the 7,500, I have to pay more tax. So let's have a look. Before we do 7,500, I have to split it. Why? Because I have still some money left, the band left from the basic. So from the basic, so basic band is 37,700. From here, I use for the non-saving, I use 32,850. And for the savings, I use 500 for the nil rate. So I still have some balance left, isn't it? So 37,700 minus 32,850 minus 500, and that gives me 4,350. 4,350. So still I have some remaining balance from the 37,700. That is 4,350, and still I can use the 20%. That's the basic rate. Remember that up to 37,700 is 20%. So that will give me 20% give me 870. So for the first 4,350 times 20%, it will give me 870. And how much I still have left? So my total savings income was 8,000. From 8,000, I use 500 for the zero rated, and another 4,350, that from the basic band remaining I use. So how much still I have to pay the tax? So I have 3,150 remaining, and this one is fall on the higher rate because I'm crossing now 37,700. I'm crossing the basic band, and here I'm going to pay 40% tax, and that will give me 1,260. 1,260. So now we can see we have the first tax, that is 6,570 for the non-saving. For the saving, we have, for the basic rate, we have 870. 870 that we pay 20% for the savings. And the last one for the remaining balance for the higher tax rate, 40%, 1260. 1260. So that makes me total tax 8,700. But remember, I'm not going to pay 8,700 because I already paid from my employment 6,570. So minus 6,570, and that will give us 2,130. This is the one I'm going to pay. So payable. The question asks for the tax payable, not the liability. If they say liability, then 8,700. But say how much you're going to pay, how much you need to pay. That is 2,130 because I already paid some tax at source. So 2,130 will be the answer number 2. All right, so you can see the small question, but a lot of workings. The next one is says, what is the Marilla income tax? The next one. So Marilla have only the property income and the interest saving. And they said income tax liability. This time is income tax liability, not the payable. So let's do that. So we have a non-saving and we have a saving. So non-saving is 13,570 and savings is 15,000. So it is like less than, I think, 37. So if I added this to 15 plus 10 is 25 plus 3, 28. So definitely it is less than 37,700. So basically a taxpayer, no problem for me. And it is less than 100,000. I have a full personal allowance. So I'm going to minus the personal allowance from here. So personal allowance, I'm going to minus 12,570 from 13,570, and that gives me remaining only 1,000. And we have 15,000 for the saving. Okay, now as soon as you see this one, my non-saving income is only 1,000. Remember, my starting rate for the savings, I have 5,000. So from the 5,000, I have only used 1,000 for the non-saving. So I still have 4,000 for the non-saving, zero rated. Very careful with that. So I'm going to say for the 1,000, I'm going to pay 20%. I'm a basic rate taxpayer. So that gives me easily calculation 200. And from this 15,000, I'm going to use 4,000 first. So first 4,000, I'll pay zero rated, that's zero. Then I'm a basic rate taxpayer. I'm going to get another 1,000 zero rated. So 1,000, that is zero rated. So I'm going to pay zero. So 4 plus 1, 5. So on this 5,000, I don't pay anything. So I have a remaining 10,000. In this 10,000, I'm going to pay 20% because I'm a basic rate taxpayer. This is 2,000. So we have a 2,000 plus 200 from the non-saving. Added this to 2,200 is my tax liability. They're not saying how much I need to pay. They're asking how much is the tax liability. So 2,200, this one. Very careful with this one. The starting yield rate band. Always careful with the non-saving. If the non-saving is 4,000, then you have only 1,000 left. If the non-saving is 1,000, you have 4,000 left because the maximum is 5. All right, let's move on to the next one, Fabian. So let's have a look. Income tax liability. Okay, for the Fabian income tax liability. Fabian have an interest. That means only the savings income, 163,650. That is more than 100,000 and more than 125. That means 140. That means I have nothing to do with the personal allowance. I'm not going to get any personal allowance, losing all the personal allowance. So don't worry about the personal allowance. Now, the next thing we have to know, how much is the tax I have to pay on that. Now, I am an additional rate taxpayer. 163 means is more than 150,000. If I'm additional rate taxpayer, remember that I have nothing for the allowance for the savings. If I'm a basic rate taxpayer, I have a 1,000. If I'm a higher rate taxpayer, I have a 500. But if I'm an additional rate taxpayer, I don't have any allowance for the saving. But I might have a additional, might have a starting rate savings that is 5,000. You always know that 5,000 because we don't have any non-saving income. So the full 5,000 I can use for the non-saving. This one could be very tricky. Remember that, because we don't have any non-saving income. So we have the full amount of 5,000 that I'm going to calculate 0%. It's called starting rate saving income. So from the 163, the first thing I'll do, first 5,000 multiply by 0 rated. I'm not going to pay any tax on this amount because I have the full amount. It's a starting rate. Then the next one will be my basic rate. Now we already know my basic band is 37,700. From here, if I already use 5,000 for the 0 rated, so I still have 32,700 left. And here I'm going to pay my basic rate, and my basic rate is 20% always. So the next 32,700, I'll pay 20%. That's my basic rate tax, 6,540. And the next one, I'm going to find from the basic to the higher rate. And this is the difference between our 150 and the 37. So let's have a look how much it is. So we have here the next one. Let's try to find the difference. So we have 150,000 minus 37,700. We should remember this amount because it's fixed 112,300. So it's fixed anyway. So for the next 112,300, the way we get the difference between the basic and the higher. So our higher band is 150 and the basic is 37,700, isn't it? The difference here is 112,300. And this one we pay 40% rate. So 112,300 and 40%, that will give us 44,920. 44,920. And finally, the difference between the 150 and 163,650. So let's do that. So we say my 163 is the total saving, 163,650 minus 150,000. That gives me 13,650. So that's 13,650. I have to pay the additional rate, that is 45%. And that will give me 6,142. And that's it. Now, if I added these three, that will give me total 57,602. So this is my total income tax liability for Fabian. So we say 57,602. Let's have a look. We're going to write here 57,602. 643, sorry. 57,643. 57. All right, so yeah, I think that's it for this one. Let's have a look. So this is basically 57,602. So it's not 40. If we added all of this, it's 57,602. All right, so this is the calculation for the savings. Then we have the activity 6 is the income tax payable. So we'll look at this question as well. Let's see how's it work. So in this question, income tax payable for the activity 6, let's have a look what we have here. If okay, so again, we're looking for the income tax payable here. Okay, so F has the following income in the tax year. So we have a salary, this is non-savings, PAYE, that is the tax deducted at source. So tax deducted at source. That means this tax is already paid. Building society interest, so this is my savings income. That's the non-saving income, and that's the dividend. All right, so how much is the tax payable? Let's have a look. So you need to make a template for that. We make a template for non-saving income, we make a savings income, and we make a dividend. So the non-saving, we have salary, that is 11,370. Then we have a building society interest, that's the savings income, 10,000. And the dividend, we have 54,500. So that's it. Now we're going to make some total, how much it is. So we have 11,370, and we have a 10, and we have 54. The reason we need to make total to check, are we still eligible for the personal allowance or not? So if we see 54 plus 10, 64, plus 11 is 74, is less than 100,000. So that means we are eligible for the personal allowance. So you're going to use my personal allowance from non-saving first, then we go to savings, then we go to dividend. So let's have a look. The first personal allowance, I want to take it out from my non-savings. So I have a non-savings income total 11,370. So I'll make it 0. I'm not going to pay any tax on my non-savings income because it's all covered from my personal allowance. But I still have some personal allowance left. We already know our personal allowance is 12,570. So from the 12,570, we have used 11,370 for the non-saving. So still we have 1,200, 1,200. This 1,200 we're going to take away from the savings income. So minus from the savings income 1,200. So we'll have a savings income remaining 8,800. And that's it. And the dividend is still remaining same, that is 54,500. And if we make total these two, 8,800 plus 54,500, that will give me 63,300. So that's my taxable income. That's my taxable income. So on this taxable income, I'm going to calculate the tax. So the taxable income is 63,300. All right. Now, before we start, we need to remember a few things. As the non-saving income is 0, that means I have still 5,000 starting rate band, 0 rated for my savings income. And my total net income is less than 100,000, but more than 37,700. So I'm a higher rate taxpayer. That means still 500, I'll get the allowance for the savings income. So you need to remember that as well. So let's try to do the calculation first. So the first one, we're going to start with this 5,000, that is starting rate. So first 5,000, I'm not going to pay any tax, 0 rated for the savings from the 8,800. So I'll take 5,000, 0 rated, no tax, because I didn't use anything on the non-saving from the 5,000. This one you have to be very, very careful. If you use any amount on the non-savings, that means after the personal allowance, if we have any amount left here, it will be minus from the 5,000. The next one we're going to look at, that is my next one. So that will tell me how much it is. So the first 500, I'm not going to pay any tax because I'm a high rate taxpayer. So first 500, I'll do 0 rated. So 500, 0 rated again. So no tax on that as well. Then how much we have remaining? So from 8,800, 5,000, 0 rated. Then another 500 is my allowance. So how much you have remaining here? So you have 3,300. In this 3,300, I have to pay the basic rate, 20%. So 3,300 at basic rate, 20. And that will give me 660. So this is my saving story finish. If I added all of these three, that will give me exactly 8,800. So 5,000 is free, another 500 is the allowance, and remaining 3,300 I'm paying on the basic rate. My basic rate is 37, the basic band is 37,700, remember that. So from 37,700, I have used 8,800 so far. The next income I have, the dividend, that is 54,500. Let's have a look how much is the tax coming for the dividend. Now for the dividend, first 2,000 is free. We already know that. Regardless of the income, doesn't matter how much is the income, remember that. The first 2,000 is free for the dividend. So 0, no tax on the dividend. That's the first one. The next one, we're going to look at how much money we have left over, or how much is the basic band remaining, so that I can use it for my basic rate, tax rate for the dividend. So from the 37,700, we need to see how much is remaining. So 37,700 minus, we have 8,800 that we have used for my savings, and also we have used 2,000 for the nil rate band. So how much we have remaining? So we have remaining 26,900. So this is the basic band we have remaining, and we know the basic band is 20%, and for the non-saving, for the saving is 20%, but for the dividend is 8.75%. So times 8.75%. Remember that the rate of the dividend is different. So basic rate is 8.75, then we have a 33, then 39. So we need to remember the rate. So we have 26,900 times 8.75%, and that will give us 2354. 2354. And after that, the remaining, so how much we have remaining with the dividend now? So the dividend was total 54,500. So from 54,500, we already used 2,000. We already calculated the tax 26,900. So how much we have is still remaining from 54,500. So we have 25,600 still we have. And on this 25,600, that will go to the higher rate. So basic rate is finished, because up to here, my 37,700 is covered. Anything after 37,700 will go to the higher rate, and the higher rate dividend tax is 33.75%. 33.75, and that gives me 8,640. And that's my total tax. So 660 plus 2354 plus 8,640, that will give me total 11,654. And from here, I need to see, is there any tax I already paid as deducted at source? And we said earlier, PAY is 75 that I already paid when I was working as employee. So I'm going to minus this one, 75. The rest of the tax I need to pay, that is 11,579. Here's the tax payable. If the question asks you tax liability, then it is 11,654. But payable means after deducting any tax if I already paid. That's it. All right, let's move on to the next one. Let's have a look. So the next one we have here, tax liability. I think is the same question we have, non-saving, saving dividends. You already know this thing. So we'll ignore this one. We'll skip this one. We move to something new. The next one we have here, transferable personal allowance. So now we're going to look at how can we transfer the personal allowance from husband to wife or wife to husband. It's Alice and Bertha are married couple. In tax year 2022 and 23, Alice has a net income 11,220. So you can see that Alice has a net income 11,220. That means that is less than the personal allowance 12,570. And Bertha has a net income 26,570. That means it is more than the personal allowance. This is the scenario has to be, because if both persons earn more than the personal allowance, remember the marriage allowance will not work. It will not be helpful. But if one person earns less than the personal allowance, another person paying some tax, only that case it is helpful to transfer the personal allowance. Other than it is not helpful at all. All their income is a non-saving. Alice has made an election to transfer the part of his personal allowance to Bertha. So basically, Alice wants to transfer his personal allowance to Bertha because he's not using all the personal allowance. So he have total 12,570, but he was using at this moment only 11,220 because that's his income. Okay, so let's do that. The solution, not saving income. So net income for the Alice, 11,220. And the personal allowance, so how much he can transfer maximum? Remember that. He can transfer maximum 1260. That's the maximum, 1260. So he cannot do more than that. Remember that. So that is the amount, 1260, that you can transfer. So the personal allowance will be reduced for the Alice. So normally it is 12,570. But if you minus 1260, so the remaining personal allowance will be 11,310. And that cover all the income. So he don't have to pay any tax anyway, because he is earning only 11,220. And if he can use personal allowance 11,310, that means he don't have to pay any tax because it's cover everything. Now this 1260 will be added with the Bertha personal allowance. So normally Bertha have a personal allowance 12,570. This 1260 will be added with that. So if you look at the Bertha, the net income is 26 and minus the personal allowance for Bertha 12,770. So his taxable income is 14,000. On 14,000, he will pay 20% tax, that is 2,100. Now, transferable personal allowance tax will reduce 20%. So you see this transfer coming from here, and 20% tax on that, that is 1260. 20%, 252 will be reduced. So he don't have to pay 2,800 tax. He can pay only 2,548 because 252 will be reduced every year. Now it is the same thing if you can do the calculation like that, 26,570. And if you make more personal allowance, so let's say rather than minusing 1250, you can say 1250 plus 1260. So how much it is? So 12,570 minus 1260, that is 13,830. So we can minus 13,830 minus 26,570, that is 12,740. This is the amount will be his taxable income. So if you do 20% on that, that will give you exactly the same figure, 2,548. That means how much personal allowance transferring from the wife to husband or husband to wife, it will increase his personal allowance and he paid less tax on that. This is the situation, but it is only helpful when the husband, between the husband and wife, one person is paying tax and another person income is less than the personal allowance. All right. Let's have a look. We have one question here. Let's try to do it. Activity 8. Transferable amount of personal allowance. Ash and Dan are married. Ash has a trading income 10,090 and Dan has employment income 43. So one is earning less than the personal allowance, another one is more than personal allowance, paying some tax. How will the transferable personal allowance work for Ash and Dan? Now obviously, like you can see, there are a few options. It is not allowed, as Dan is a higher tax rate payer. It is not allowed. Ash is using some of this year personal allowance. Ash transfer 1260 to his personal allowance to Dan, or Dan transfer. Now this is the question. You have to be very careful to understand this one. We always look for who earning less. Remember that. We always looking for who earning less. Now in this scenario, we can see here, Ash have a less income. So Ash need to transfer to Dan because Ash is telling, like, listen, my income is less than 12,570. So I'm not using my personal allowance anyway. So why not I transferring to my husband? So he will transfer 1260 to Dan. Ash will transfer to Dan. So normally that Dan have a personal allowance 12,570, and this will be added from the ASH 1260, and the new personal allowance will be more for Dan. That means he will pay less tax. So Dan will pay less tax. There is no impact on the ASH anyway, because ASH will not pay tax anyway, because his earning or her earning is 10,090. So it will be covered from the all personal allowance, because her personal allowance is 12,570. Even if I minus 1260, still it is more than 10,000. So that means all the personal allowance will cover all the income for the ASH anyway. So ASH can transfer remaining personal allowance, that is maximum 1260, to the husband. And Dan will pay less tax because his personal tax will go up. What is the Dan income tax liability? Okay, so Dan have a 43, very simple, 43,620. Now the personal tax will be how much for Dan? So he have his own 12,570 plus 1260 from the wife. So his personal allowance will be now 13,830. So minus 13,830. That is 29,790. And if you do 20% on that, the basic rate taxpayer, and that will be 5,958. 5,958. And for that reason, sometimes we can see we received the letter from the HMRC after we claiming the personal allowance, and the HMRC said like your tax code will be changed because you apply for the marriage allowance. So on the tax code, if you are a payroll manager, if you already know how does it work, if you're working in the payroll, so basically you change the tax code from 1257L to 138L. So basically you don't pay tax up to this amount. All right, so this is quite simple. It's not difficult anyway. So let's look at the gift aid. It is quite important, very, very common in the exam. So the gift aid or the charity have a two impact. The first one, it will have impact on the adjusted net income. So net income will be adjusted. For example, if my net income is 110,000, because of the gift aid, my net income will be reduced so that I can have more personal allowance. Number one. Number two is my basic band will be extended. So that means I'll pay less tax. So gift aid, one-off and regular charitable gift of money qualifying for tax relief under the gift aid scheme, provided the donor gives the charity a gift aid donation. So when you give a charity, of course you are giving charity, so the HMRC will give you some tax advantage, nothing else. Okay, say like basic band and additional band. So basically, if your income is more, for example, if your income is 200,000, and if you give 10,000 charity, so of course, like on the higher rate basis, if your tax rate is 45%, so 45% on 10,000, you get the tax advantage. That's all basically the simple thing. I think we'll look at one example. It will be more clear after. So let's have a look. This one. So illustration 8, gift aid, the basic rate band and adjusted net income. Is the Margarita earned a salary of 112,000 in 2022 and 23. In January 2023, she made a gift aid donation 5,000. Now you can see here, gift aid donation is a net. Remember that it will be always given as a net. We have to gross it up. And you have to always think the tax rate will be 20%. So when you gross it up, you have to make it 100%. So if it is 5,000, so if it is 5,000, and that represent 80%, you have to gross it up by 0.80. So 5,000 divided 0.80, that will give us 6250. So from the net, you have to make it gross. The way we do the VAT gross, we do the same thing for here as well. All right, so if we have a look here, they said, what is the impact? Now let's have a look, the impact. The first thing we look at here, that is the income. So the employment income or the net income she have, that is 112,000. And from the 112,000, you can see when the income is 112, that is more than 100,000. That means we have to stop and check the personal allowance. Now, normally what we do from the 112, we do minus 100,000. And that gives me 12,000 extra, and we divide it by 2. And 6,000 we minus from the personal allowance. So normally the personal allowance is 12,570, and we minus the 6,000 because of the excess, and that gives me my remaining personal allowance. But we're not going to do it here because she has some gift aid, so that will change my adjusted net income. So let's have a look. How does it work? So if you have a look here, personal allowance adjustment, so net income is 112,000, but we are reducing the net income. So even though the net income is 112, but because of the gift aid donation, we reduce her net income. So we said like she make a gift aid 5,000, and we gross it up. So you can divide by 80 times by 100. But normally what I do just divide by 0.80, because 20% is the tax. That will give me the same thing, 6250. So this 6250 I'm going to minus from the net income. So my net income will be reduced. So before my net income was 112, but after adjusting the gift aid, you can see my net income is now, adjusted net income is now 105,750. That means I'm not going to consider 112 anymore. I'm going to consider 105,750. But remember, this is only for the personal allowance adjustment, not for the income tax calculation. When you look at the income tax calculation, it is again 112. But this 105 only for adjusting the personal allowance, nothing else. So 105, we have a limit. The limit is 100,000. We are not minusing the 100,000 from 112, but we are minusing the 100,000 from 105. And that gives me 5750. And if we make a half of that, divide by 2, that gives me 2875. And if you minus from the personal allowance 12,570, so my personal allowance is 9695. But if I use this 112 figure, my personal allowance will be very less, not 9,695. But this gifted donation helped me to have a more personal allowance. How? Because it will reduce my net adjusted income. And for this reason, this 9695 I'm going to use as my main personal allowance. So my taxable income is 102305, and the basic rate we have. Now again, the one more thing we have to know. So the gifted donation have a 2 impact. One, my personal allowance will be increased by adjusting my net income. So my net income will be reduced by the gross amount for the gifted donation. Also, my basic band will be extended. Now, normally my basic band is how much? 37,700 plus I need to add this 6250. So 37,700 plus 6250, that gives me 43,950. So that means my basic band is now 43,950. So now I'm going to calculate 20% on this amount, not 37,700 anymore. Because of the gift aid donation, my basic band will be extended. So you can see here, the basic rate now 43,950, and it's 20%. Normally it is 37,700. So this is the tax, and the remaining balance between the difference between 102305 minus 43,950, that is 58,335, is 40% higher rate, and that's 23. So I'm paying 32,132. If I don't give the gifted donation, I pay more tax. How I pay more tax? My personal allowance will be less, and of course, like I have a more taxable income, and also my basic band will be only 37. So I will do only 20% on 37,700, not 43,950. All right. So this is it. Let's try one more question from activity 9. Let's see what we have here. All right. So we have a gifted donation. So the question says, Gloria has employment income 120. She made a gifted donation 7,200. So first we need to gross it up. Remember that. Divide by 0.80. So 7,200 divided by 0.8. That gives me 9,000. That's my gross. I always do that first because I don't want to forget it later on. Okay, what is the Gloria personal allowance for this year? So first I need to see how much is the net income. So net income is 120, but I'm going to reduce it by the gift aid. So I'll reduce the net income, the gross amount, with the gifted donation. So 120 minus 9,000, and that gives me 111,000. So that is my adjusted net income. And I'm going to use this amount for the personal allowance. So my limit, I know 100,000, that's fixed. Minus that, so minus 100. So I have 11,000 excess, and divide by 2. So 11,000 divided by 2, that gives me 5,500. So my personal allowance will be reduced by 5,500. So normally my personal allowance is 12,570 minus 5,500. So 12,570, that gives me 7,070. So that will be my personal allowance, 7,070. It's not difficult. The next one, it says, what is the basic rate limit? So basic rate limit will be extended. So let's have a look. Normally it is 37,700. So it's not going to be this one because of the gifted donation. So 37, then 700 plus 9,000 we have. That is from the gifted donation, the gross. So 37,700 plus 9,000. That gives me 46,700. So where is the 46? 46,700 is the one. All right, let's move on to the next one. The next one, we have a qualifying interest. It's not very important. You can have a look, just read it. It's not very common in the exam anyway. So let's have a look about child benefit income tax. An income tax charge applies if a taxpayer receives a child benefit or their partner receive a child benefit and taxpayer has adjusted net income over 50,000 a tax year. So there will be income tax if your adjusted net income is more than 50,000 a tax year. So let's have a look. If a taxpayer have adjusted income 60,000, the charge is equal to the full amount of the child benefit received. So if your income is 60,000, then you pay the tax on the full amount, how much you're receiving as a child benefit. If the taxpayer has an adjusted net income between 50 and 60, so let's say 55, the charge is 1% of the child benefit amount for each 100 adjusted net income excess of 50,000. So if it is 55,000, for the 5,000, you pay 1% for each 100. And you have to round down to the nearest whole number. Okay, that's fine. If both partners have adjusted net income excess of 50,000, the partner with the higher adjusted net income is liable for the charge. Very important information. So if there is a husband and a wife, and both partners have adjusted net income excess of 50, and the partner with the higher adjusted net income, so one is 50, one is 55. So the 55 one will be responsible for the tax, like the amount you're going to use 55, not 50, the higher one. All right, let's look at one example, then we'll understand it better way. So we have here child benefit income tax. Samantha is divorced and has 2 children aged 10 and 6. She has a net income 56,000, so more than 50,000, but less than 60,000. In 22-23, Samantha made personal pension contribution PPC is 4,500 is gross. Remember that if the question give us the net, we have to make it gross, but this question give us gross, we have no problem. During 22-23, she received a child benefit 1828 in tax year 22-23. Calculate Samantha's child benefit income tax for the year 2023. So net income 56,000, no problem. And less the personal pension contribution, PPC, always minus the gross. The question gives us the gross, we don't have to make it gross. But in the exam, most likely they'll give you the net, not the gross. We minus it, so we have a ANI, adjusted net income, that is 51,500. And we minus the threshold, up to 50,000, we have no problem, so we minus the threshold. So we have a 1,500, we are liable to pay the tax, that's the excess. And for every 100, we pay £1, 1%. So divide by 100, so we have 1,500. The reason we divide by 100, because we calculate for every 100. So 1,500 divided by 100, that gives me 15. 15. And the child benefit income tax charge, so 1% of 1828, we receive 1828 times by 15. So 1828 times by 1% and multiply by 15, because we have to convert this 1,500 into 15, because for every 100 we do the income tax. So it's very important to remember that. So if you look at this line, listen very carefully. For every 100, 1% of the child benefit amount for each 100. So for every 100, 1%. All right, so then we have a next one. Let's do one activity for the child benefit. So we have a 10. So it says salary is 54,000 and child benefit 2,500. So there is no contribution, so we have no problem for that. So we need to find the difference. So 54,000, I'm receiving the salary, and 50,000 is the limit, the threshold. So 4,000 we have excess. So 4,000 we have excess. We have to divide by 100 always to convert it. So 4,000 divided by 100, because we're looking for every 100, 1%. So now we do 2,500 by child tax benefit, multiply by 1%, multiply by 40. So 2,500 times 1%, multiply by 40, and that gives me 1,000. So 1,000. It's not difficult at all. All right, let's have a look at the next one. The next one, we have a accrued income. So it's not very difficult. It's just like how you calculate the interest. Now the interest, we have a two-way calculated interest. One is interest on advance and one is interest on arrears. Advance means you can pay in advance, or arrears means after using the service at the end of the year, you pay the interest. That's very common, the accrued one. So let's have a look at this one. Accrued income scheme. It's when on 10,000 nominal value, 5% UK government loan stock, interest was payable on 30 June and 31st December each year, so twice a year. When sold the loan stock to Yvonne on 30 November 2022 for sale proceed 11,208, including accrued interest 208 for the period between July to November. So that is 10,005% for 5 months. What are the amount taxable on when and even as saving income in respect of the loan stock? So let's have a look. Interest received on 30 of June. So on 30 of June, 10,000, 5%. So 10,000, 5% for the whole year, but we have 6 months because up to 30 of June, they said like 30 of June and 31st of December. So twice the interest was payable. So when you have a government loan in stock or a bond, so sometimes the government give you more interest than the bank. So people buy the bond and the loan stock from the government. So here for the 6 month, that was interest received 250. And accrued interest deemed received on 31st of December, if he didn't sold it, is supposed to receive another 208 for the next 10,000 for the 5 month. So on December, 31st of December, 208. So total taxable as saving income, 458 for the ON. For the E1, interest received 31st of December, 10,005% for the 6 month, 250, lesser relief for accrued interest. So amount taxable on ON, that is 10,005% on 5 months. This is exactly this one. And the total taxable as savings income, example, 1 month of interest, that is 42. So this is the calculation we have, but obviously, like, you need to make sure you read this one, how is it to work. And this is not very common in the exam, but you can just quickly have a look if there is any MCQ question come, but it's not something like you're looking at a big question will come or ask you a calculation. It's a very, very rare it comes in the exam. So I think like that's it. This is the end of the chapter. There is so much we have in the chapter. We have finished finally this chapter. Hopefully this video will be very helpful for you to understand this income tax calculation, gift aid, this and that. And if you have any question, feel free to email me. You have my email on the description. You can email me for more support. If you need support for your study or something, or with the materials, you can email me. Hopefully I'll help you if I can. And also, as I said, to pass this paper, you have to be very careful with the exam techniques. Everything in this paper is exam techniques. ACCA paper could be very difficult if you don't know how to manage your time, how to approach the question, and how to make yourself ready for the exam. And so many students, they don't pass the exam because of this reason. They don't know how to manage the time. They don't know the exam techniques. So you need to be very, very careful for this exam. Now, of course, the good thing is, like, now you have more attempt, like you can do 4 times the exam. Before it was only 2 times you can do the exam, only it was June and December, but now you have a more time, you have a more attempt. The good thing. Another thing is, like, exam will be on the computer base. So of course, like, you have to make sure you are used to the computer, and a little bit typing will be helpful. Spelling is not a big thing. If you think the spelling is not very good, but for the little thing, they don't take this one that much seriously, and they will not reduce the mark for that, because in the ACCA here, they're more looking at like how you approach the question. The examiner want to see you understand what you are doing. So it is very important you understand the whole scenario. And as I always say, like, think yourself, you are the one who is earning this money, how much tax you need to pay. So you're calculating yourself, not only pass the exam, but also to learn everything. It's very important to understand the taxation to become a chartered accountant or certified accountant, because if you become a chartered certified accountant and if you don't know that taxation is not make your study complete. So you need to make sure you understand the whole thing, and keep revising, keep doing the same question. Hopefully this will be very much helpful for your future career as well, and also like to understand the taxation system in the UK. Thank you very much everyone for watching my videos. Please like the video and share if you think is helpful, and feel free to email me if you have any question. Thank you very much.